So the monetary policy works through the same logic like the fiscal policy. That means it affects the aggregate demand or the demand side of the economy, but there is a basic difference between the fiscal and the monetary policy. In case of monetary policy, there is just one tool of the monetary policy, and that is the nominal money supply in the economy, where the nominal money supply is denoted by MS. So the tool for monetary policy is basically the amount of money that is circulating in the economy. It is the amount of cash, the amount of currency that is in circulation in the economy. It will be beneficial for you to think about money supply as the total amount of cash that is circulating in the economy. In case of the monetary policy, the government of the country works in coordination with the central bank in executing the monetary policy. The central bank of a country has a big role to play in case of monetary policy. In case of United States, the central bank of United States is the Federal Reserve Bank. So the Federal Reserve is the one that executes the monetary policy. Unlike the fiscal policy, it is not under the discretion of the government. So you can understand that in case of monetary policy, this only tool that the Federal Reserve has is the total amount of currency or cash in circulation in the economy. And based on this tool, there can be two kinds of monetary policy. That is the expansionary monetary policy. In case of expansionary monetary policy, the money supply will increase, and in case of contractionary monetary policy, the money supply decreases. Now, whenever there is an increase in money supply, the aggregate demand goes up or shifts right, and as a result of that, the real GDP increases. And in case of a decrease in money supply or contractionary monetary policy, the aggregate demand goes down or shifts left, as a result of which the real GDP decreases. So based on this connection, you can understand that the expansionary monetary policy would be appropriate in case of a recessionary gap in the economy. So whenever there is a recessionary gap, the economy will need an expansionary monetary policy, and whenever there is an inflationary gap, the economy will need a contractionary monetary policy. So whenever there is recessionary gap, the money supply has to increase, and whenever there is an inflationary gap, the money supply has to decrease for the economy to come back to the long run equilibrium, that is on the vertical long run aggregate supply curve. Now, in order to understand how this monetary policy works, first we have to understand the working of the money market. So let us go back to our microeconomic concept of a market. Now in microeconomics, if you remember, we had said that the market is microeconomic because we are dealing with one good at a time. So here we are dealing with a good which is the amount of money in the economy. So that is the market we are dealing with. So on the x-axis we have the quantity of money. Let me write that as QM, and we have the money demand curve which looks somewhat like that. Let me call it DM. So DM is the money demand curve. Now on the x-axis we have to put the price of money. Now price of money sounds very weird because you cannot buy money by paying money, right? You cannot buy $10 by paying $20 or $5. So what is really the price of money? The price of money is basically the opportunity cost of holding cash. Because remember, what can you really do with cash? There are two options. You can either spend the cash or you can save or invest the cash, right? If you spend the cash, then you can buy the goods and services with it, but then you give up the opportunity, you sacrifice the opportunity of earning any return on that money, right? So whenever you hold cash, whenever you do not invest the cash, what you are giving up is basically the possibility of earning any return, the possibility of earning any interest, and what you give up is your opportunity cost, and that is your cost of holding money. Let me give you an example. If you have $100, you can keep the $100 in your pocket, or you can put that $100 in a bank and earn 10% interest, right? 10% return on that $100. Now, if you decide to keep that $100 in your pocket, then what have you sacrificed? You have basically sacrificed the 10% rate of interest, isn't it? The 10% return. So you have given up $10. This $10 is your cost of keeping that money in the pocket and not investing it. So basically the price of holding cash is the rate of interest or the rate of return, which is denoted by R. So R is the rate of interest, which is basically the same as the opportunity cost of holding money. Okay. Now that is the money demand curve. When it comes to the money supply curve, the money supply curve is vertical. It is not upward sloping, unlike any other supply curve. You have seen that the supply curve for any other commodity like apples or ice creams is usually upward sloping. But in this case it is vertical, because no matter what happens to the rate of interest, the money supply curve is fixed, and the quantity of money that is circulating in the economy is also fixed. Why is it fixed? Because it is determined by the central bank of the country, Federal Reserve in case of United States. So it is independent of what is happening to the rate of interest. The demand for money is dependent on the rate of interest. If the rate of interest goes up, people will demand less cash. If the rate of interest goes down, people will demand more cash. Why? Because if the rate of interest is high, then it is good for me to put the money in the bank and not keep it in my pocket. So my demand will be low. And if the rate of interest is low, then I don't have to put the money in the bank. I would rather keep it in my pocket, right? So there is an inverse relationship between the demand for money and the rate of interest. But when it comes to the supply of money, there is no such relationship. The supply of money is independently decided by the central bank of the country or the Federal Reserve Bank. And that is a fixed number. It's a fixed quantity. And hence it is a vertical line. Now at that intersection of the demand and supply curve, you have the equilibrium rate of interest in the economy. Now please note that if there is an increase, if there is a right shift of DM, for whatever reason, if the demand for money goes up, then there is an increase in the rate of interest. And for whatever reason, if the demand for money comes down, then there is a decrease in the rate of interest, right? Let's write that down. If demand for money goes up, then rate of interest goes up, and if demand for money goes down, then the rate of interest goes down. Now whenever this happens, then please note that the interest rate effect will kick in, and we have covered the interest rate effect before. We have covered it in module, I think we have covered it in module 4 unit 1. So please go back and look at the video that talks about interest rate effect. So whenever the rate of interest changes, the interest rate effect will kick in, and as a result of that, the aggregate demand in the economy will get affected. So if demand for money goes up or demand for money goes down, that will affect the rate of interest in the economy, and as a result of that, the interest rate effect will kick in and the aggregate demand will be affected. Please go back to module 4 unit 1 and take a look at interest rate effect, listen to interest rate effect and see what I mean by interest rate effect, okay? So the interest rate effect will kick in and the aggregate demand will get affected. But please note that this part, the demand for money changing and hence the aggregate demand getting affected, this is not monetary policy. Okay, because monetary policy has to be executed through the supply of money. Anything happening to the demand curve for money is not monetary policy. Please understand, any increase or decrease in the demand for money will have an impact on the economy, and it will have an impact through the interest rate effect, but that impact is not monetary policy. Okay, so we have not spoken about monetary policy yet. I'm just talking to you about the money market, and I'm talking to you about the demand for money. We haven't touched the supply of money yet, but I just want to tell you that anything that happens to the demand for money is not monetary policy. Okay, now what are the factors that can affect this demand for money? Now the demand for money can get affected by factors like aggregate price level in the economy, and it can get affected by banking institutions and technological development in the economy. For example, let's say in the economy, lot of local banks are started. Okay, the banking industry expands in a country, and this banking industry is driven by technology. You have lot of ATM machines, teller machines. What will happen if you have ATM machines? Then obviously you will not need to hold the money, isn't it? You don't need to hold money as cash in your pocket. So your demand for money is going down. What will happen if there is a lot of technological e-commerce, online sales, online buying? You don't need to hold cash in your pocket, so your demand for money is going down. So that demand curve is coming down. Okay. How about aggregate price? If aggregate price in the economy goes up, then you need more cash to buy the same goods. You can buy apples for $2 yesterday, today it is $10, so you need $8 additional to buy the apples, right, the same apples. So that means your demand for cash is going up, so you will experience an increase in demand. So those are the two factors that influence the demand for money, and that demand for money will have an impact on the economy, but that impact is not counted as monetary policy. Now in the next video, let us see how the money supply can change and how that impacts the economy. Okay, what is the effect? Basically in the next video we will see what is the effect of monetary policy in the economy and how is that monetary policy executed. What does the Federal Reserve Bank do for that monetary policy to work in the economy?